So just quick introduction to the team. Shane Fox, who's going to be joining us and discussing and helping me on the presentation, as well as Geoff Degener. In addition to that, Sean Fasanella and Jen Fisher. So for those of you, thank you for joining us as we go through, I think, a very relevant and important topic, year-end tax planning. First of all, I just want to start with, there's a reason we're having our year-end tax planning discussion in mid-November. And the reason for that is to allow our clients the ability to make any changes between now and the end of the year to reduce taxes or maybe even increase taxable income for planning purposes. So hopefully the takeaways are going to be a few tips, maybe a few action items that you can take with you and then implement before the end of the year. If we're doing this December 15th, you'll be left scrambling with only a week or two to implement any potential changes. So with that, we'll kick things off with the necessary disclosures, followed by the importance of having an understanding of what your income is. So we recommend that either through a CPA or even back of the envelope or utilizing us, going through and creating an income estimate year to date. So as we stand today, what is your total income? And then you can kind of look through any adjustments, deductions, things of that nature, because that really sets the stage for whether you're going to be able to take advantage of some of these opportunities. It's critical for financial planning purposes. First of all, what tax bracket are you going to fall into? How is your income going to be taxed is pretty critical. It also is going to lead to the ability to make IRA contributions or Roth IRA contributions. If you're making an IRA contribution, you just need earned income. However, the ability to deduct that IRA contribution is determined based on current income. And it's yes or no. Either you can make the IRA contribution and deduct it, or you can't. You can just make a non-deductible IRA contribution. Same thing goes for Roth IRA contributions. Either you fall under the income threshold, which we'll get into later, and you can make the Roth IRA contribution, or you can't. Simple as that. A very common and we think critical strategy for our clients is Roth conversions, which can be taxable, which are taxable events. Very common for clients that are in those gap years that we refer to them as. After retirement, before minimum distribution start at age 72, many times retirees are in a lower income bracket than they will be post 72. We do a lot of Roth IRA conversions. Well, that tax on that is going to be determined based on income. And the larger the Roth conversion, the higher the tax, and that could be pushing individuals and families into higher tax brackets. The effect that minimum distributions, as I spoke to earlier, they're going to kick in at 72. What effect does that have? Well, that's an income item. So that's also going to be determining and added to your total income number to determine what tax bracket you fall into, and then ultimately what tax you're going to pay to the federal and state governments. The tax or the impact of IRMA. So IRMA is Medicare premiums. And essentially there's a tiered, and this is if you touch the line or not. As we know, our tax bracket system is all graduated, right? If you fall into a certain tax bracket, only the amount of income in that bracket is taxed at that particular rate. However, IRMA premiums are based on at the number or not at the number, meaning that if you cross over that threshold by $1, you're going to get hit with a higher Medicare premium, and your spouse if you're filing jointly, just for crossing over even by $1. It's not graduated. So the more income you have, the higher your Medicare premiums are going to be. This is important in understanding this, running these estimates if you're going to be making stock option exercises or Roth IRA conversions and things of that nature. And then also your income should be important to take an impact and look at the assessment of Social Security. Sometimes this might be a deciding factor on taking Social Security at 62 versus delaying it later. Social Security is taxed. So if you're taking Social Security, that's going to eat up part of that bracket that might leave less room to do a Roth conversion, for example, for a retiree. But Social Security is taxed a little bit differently. So with that, let's kick it to the next slide. And Geoff, why don't you take that one?
Thanks, Rory. So as Rory mentioned, and he did say Social Security is taxed, but not in every case. So as you can see here, at the federal level, Social Security potentially could be taxed, but it's dependent upon your income. So certain people can potentially qualify to have 0% of their Social Security taxed, or even 50%. I tend to see more often than not the 85% number comes into play. Those income thresholds are fairly low. And later on, I'm going to tie this full circle in terms of talking about the difference between state and federal tax. But in terms of the federal tax on your 1040, it's actually listed on line 6A. You'll see the gross Social Security amount between, spouses. 6B would be the taxable amount. And again, in most cases, we tend to see 85% with individuals that have income over 44,000. At the state level, so your federal taxable income relative to your state taxable income can be two totally different numbers. And as you can see here, there are 12 states that don't even tax, or I'm sorry, 12 states that currently do tax Social Security. A majority of them don't. And of those 12 states, a majority of them provide, certain income exclusions to offset that tax or make it a little bit easier felt. None of which, a lot of the states listed there below that do tax Social Security are not entirely relevant with our client base. I don't want to say that we don't have clients in those states, but it's we'll later on we'll focus on a few states that include New Jersey, Pennsylvania, and a lot of states that folks are retiring into.
Great. Thanks, Geoff, for that clarification. Heading into retirement account distributions, which are taxable items, Shane, why don't you talk us through prior to 2019 how that was working if you inherited a retirement account, because this is confusing. There's been a significant change.
Yeah, thanks, Rory, and great introduction there. Good afternoon, everyone. As Rory alluded to, before 2019, when it came to a inherited IRA, you were able to what we call stretch the distributions over the course of your lifetime. No matter what, right, prior to pre-2019, the age at which you had to take the minimum distribution, right, was age 70 and a half, or April in the year after which you turned 70 and a half. Since then, with the Secure Act, there has been some changes made to not only the minimum distribution age, but also the RMD amount that you're required to take. So Rory, why don't you tell us a little bit more about the Secure Act and what some of those changes were within?
I mean, in short, the word I describe as gray. It's a gray area. The Secure Act affects any inherited IRA after December 31st of 2019. And that legislation impacted a 10-year distribution rule. So the elimination of the ability to stretch IRA distributions for an inheritor over their lifetime. And now that's been shortened to a 10-year window. The gray area comes in with, well, does it have to be yearly? If it is yearly in that 10-year period, is it evenly over 10 years? Is it based on your life expectancy? Is it based on the deceased's life expectancy? So unfortunately, that's still a little bit gray. However, just recently, the IRS issued guidance that for distributions in 2021 and 2022, or rather failed minimum distributions for that period of time, they are not going to impose the 50% excise tax. And in fact, that's what's confusing. Many times it's referred to as a penalty. The reality is it's a tax. So any individual that has a minimum distribution or an inherited minimum distribution, failing to take that amount, is that the penalty or tax is actually 50% of that failed amount. So many times this can be the largest tax or largest penalty that you'll see as a tax filer. So the guidance now is that it's a gray area. Early 2023, we hope to receive final guidance on how over that 10-year period is the actual legislation and rules for taking the distributions. From what we've read at Ausperity, we think that it's leaning towards a yearly distribution is going to be needed each of the 10 years. However, that minimum distribution is going to be based on the deceased life expectancy. There might be some changes on whether you inherit an IRA from an individual that was taking minimum distribution, so was of age, or might have been prior to age 72. So there's still some gray area there, but I think the key takeaway is if you didn't take a minimum distribution from an inherited IRA that you received after December 31st of 2019, you're not going to get hit with that additional excise tax. And then it makes it theoretically optional this year, but that's where there's some planning opportunities. If you're in a higher income year this year versus next year, maybe you do take the fact that maybe you don't take that minimum distribution and wait until next year when you're in a lower bracket to begin distributing assets under that 10-year period of time. Or if you're in a very low tax bracket or you have low taxable income this year, but next year you expect to have higher taxable income. Why? Maybe you're going to start collecting Social Security next year. Maybe there's a stock option that you've had and you're going to elect and utilize that stock option transaction. Or maybe there's Roth IRA conversions that you plan on. This could be an opportunity and could be a planning item. But the big takeaway is still a gray area. However, there is not going to be that 50% excise tax on missed inherited IRA distributions for 2021 and 2022. Now, there's no reprieve if it's a regular IRA and you're age 72 or older. You still have that required minimum distribution. As Shane mentioned, that changed from age 70 and a half to age 72. So now that's still in play. You have to take that minimum distribution. It's taxable income. However, a QCD or a qualified charitable distribution is a critical planning opportunity that we at least educate our clients on. The only way to do a minimum distribution out of an IRA and not have that count as an income item is for it to go directly to a charity. That is a qualified charitable distribution. You can do up to $100,000 per year of qualified charitable distributions. And many times, due to the fact that 90% of current tax filers are not itemizing their deductions, they're taking the standard deduction. This is a phenomenal opportunity to transition money out of the IRA, make your charitable contributions. It counts towards your minimum distribution requirement. It is not taxed, and it leaves the ability to take that full standard deduction as well. So that is a many times often overlooked planning opportunity. So inherited IRA post 2019, theoretically optional for this year, but starting in 2023, that excise tax is in play. If you're over 72, you have a minimum distribution requirement, still have to take that. That is on. The only way to reduce that and have it not be an income item is a qualified charitable distribution. Getting that, I think this feeds right into the tax withholding. If you're doing your minimum distribution, you can have your tax withheld on a federal and also on a state level, and you can determine what that is. And for our clients, it's something that we can change for you just verbally. But Shane, let's go through why tax withholding is an important item and just how that shows up as well.
Yeah, Rory, thanks again. And you nailed it on the head. This is a critical item when it comes to financial planning and certainly what we do for clients. And as you alluded to at the beginning, it all comes down to knowing your income, right? And that's why that slide was important for us to start with, because it's very important to know, total income for the year. If you don't know it down to a T, at least have, as Rory alluded to, a back of the napkin or a ballpark figure, because it really helps not only you, but us in guidance to what you should be withholding when it comes to IRA distributions or RMDs or whatever it may be. One of the biggest things that I experience, and I think we all experience, right, is taxes, right, at the beginning of the year, and sometimes having a surprising tax bill, and that is what kind of this slide is talking about, right? Number one, and the first and most important thing that you can do, right, especially if you're a W-2 employee, is to make sure that your current tax withholding is in line and appropriate. So most of the time, consulting with your accountant or just making sure that your withholding item, your withholding amount is proper and in line. And that way you don't have to be kind of hit with a big tax bill at the beginning of the year because you haven't been withholding enough for the previous year. Another way that you need to do and something to be aware of is that if you're not doing that, right, or if you're receiving some kind of RSUs or some kind of stock options, you may be in a position where you need to make quarterly estimated payments throughout the year. Certainly, that is something that we can help with, but it's something very much to be aware of yourself, also with your accountant, because there can be penalties if you're not making these payments throughout the course of the year. One of the things that Rory talked about, and I'll just skip ahead here, one of the biggest things that we see for a lot of our clients in their executive position, is under withholding when it comes to stock options and when it comes to RSUs. One thing that many of our clients have in common is that they're receiving, RSUs or LTIs every single year. And typically with these companies or with Fidelity, there's a standard withholding. No matter how much income you're making or you and your spouse are making, there's a standard withholding of 20 or say 25%, when realistically you may be in the 35% bracket. So there's some under withholding that goes on there. So it's always very important to keep in mind, you're not going to be able to change that with Fidelity. That is a standard withholding that they do, but it's something to keep in mind where if you do receive it at the beginning of the year, you may be in that situation where you need to start doing some of those quarterly estimated payments in order to avoid that penalty. On the other kind of points here, I just talked about the fact that many of our clients are doing retirement account distributions. Very important for us to be pretty spot on with the amount that we're withholding for the Fed, also for the state. Again, just to not have any surprises come the beginning of the year where clients need to or have a big tax bill. And if they don't have the cash on hand to pay it, then again, we're going back to the well with retirement accounts and having to take out of there. So another thing to keep in mind and, have that income in mind to make sure we're withholding the proper amount. And then again, for the last thing here, just to reduce interest on under withholding, one thing that you can do, again, speaking with an accountant, speaking with us, is you can pay the lesser of your 2022 tax, or you can pay 110% of your 2021 tax liability in terms of a quarterly estimated payment in order to reduce the interest on under withholding. So a couple of things in there, but again, very important to just know, what's my ballpark income and how much should I be withholding for retirement account distributions, or how much should I be paying maybe on top of what I'm currently withholding with my job.
Excellent, Shane. The key point there is you want to reduce surprises. No one wants that surprise tax bill at the end of the year. And then even worse, you don't want to have underpaid your taxes throughout the course of the year and then impose an interest penalty as well. So if you receive a large restricted stock vest, or if you exercise a stock option after the fact, look at that pay stub, look to see what the percent withholding was, what the tax withholding was, and then theoretically make the corrective adjustment by making an estimated payment, or at a minimum just meeting with your accountant to make sure that checks in. So as we're talking about income and things that add to income, minimum distributions, vesting of stock, things of that nature, how can we reduce income, right? How do we pay less in the form of taxes? Well, charitable deductions are going to be one, and obviously the most common. However, as I mentioned before, 90% of tax filers are taking the itemized deduction after the standard deduction was, or taking the standard deduction rather than itemizing, because a few years ago, we doubled the standard deduction. So now that's only about 10% that are itemizing their deductions that are above $25,000, $27,000, or $30,000. So if you're charitably inclined and want to continue to give to charity, but potentially frustrated that you're not doing it and not getting the benefit as an itemized deduction, a very interesting strategy is the use of a donor advised fund. This is where you can make a bundled gift. Possibly you put 5 years of charitable deductions into a donor advised fund. You will receive a deduction equivalent to that total amount in that calendar year. It then in future years allows you to distribute the assets from that donor advised fund to charities, multiple charities over multiple years. You don't get a second deduction there, but it allows you to take the standard deduction in future years. So it's a way of kind of leveraging what your charitable interests are and making sure that you receive the benefit of receiving that deduction, right? So many times it's some planning and thoughtful planning, maybe looking years ahead. Hey, if I want to be charitably inclined and continue to be so, what's the most effective way to theoretically do that? Qualified charitable distribution is one of those, which we talked about before. I think that's step one. If you have an IRA and you're over 72, your charitable contribution should be coming from that IRA. If you want to do some bundling, utilize a donor advised fund, put those assets in. You don't need to distribute it right away, but you'll get an upfront deduction for the equivalent value of that donor advised fund contribution, and then utilize the standard deduction to your benefit, as 90% of tax filers are. Another way of reducing income, the triple tax-free method, Geoff, HSAs. I know you did a piece on this in a webinar. You are a resident HSA expert. I'll let you take this one away.
I appreciate that commentary, and I'd welcome anyone to reference the video, which is on our YouTube page about HSAs. Again, it's a highly looked over account from my perspective. The HSA, the money goes in tax deductible, so it reduces your taxable income. It grows tax free, and if it's used for a qualified medical expense, it's a tax free distribution. In a lot of cases, I see, an individual or let's just say a company may provide an incentive if the individual is participating in a high deductible plan, where they'll match 100% of the first $1,000 that is contributed. Well, for an individual, the contribution limit is $3,650, so $3,650. If they're only putting $1,000 in to get that $1,000 match, they're leaving money on the table.
Sure.
So they have an additional $1,650 that they can contribute. And even if they did not elect to do so at the start of the year, they still likely can go in, link a bank account, and make that contribution. Mm-hmm. If they're over the age of 55, they also have a catch-up contribution, which increases, your individual contribution from $3,650 to $4,650. For a family, the contribution limit is $7,300. So if both spouses are working and they decide to use, let's say, spouse A's high deductible plan, and they have access to the HSA, they're both over the age of 55, that spouse can make a contribution of $8,300. So their family contribution of $7,300 plus $1,000 catch-up. The other spouse, if they're over the age of 55, can also make a catch-up contribution, but they would have to establish their own HSA account. It's very easily done. You don't have to have earned income. It's a matter of, Fidelity even offers HSAs. We have the ability to establish them for clients. It's technically like a bank account, but in order for them to optimize, their deductibility, they would have to establish their own HSA and make a catch-up contribution of $1,000 to that.
Beautiful. Thank you, Geoff. Great.
Yep.
In addition to that, 529 contributions. Now, this is not federal. This is only certain states, and this would be only on the state level. Can you get a deduction for making 529 contributions? For example, in Pennsylvania, you can contribute to any state plan and receive a state income deduction on that up to a certain contribution amount. Tax loss harvesting is a way to reduce income. How do we explain that? Well, this year, unfortunately, is a year where markets have not been kind to us, stock markets and bond markets alike. So what you can do, right, is harvest some losses, meaning sell investments that you have that have dropped in value, theoretically booking that loss, and then there's a carryover effect. However, before the carryover, you have the ability to deduct up to $3,000 of losses, capital losses, from ordinary income. For someone in a top tax bracket of 37%, that is equivalent to over $1,000 of tax savings. We've been actively doing this for our clients. Again, Geoff, you actually did a specific webinar on custom indexes, which is something that we utilize for a number of clients that have large non-retirement accounts, because that strategy actually focuses on creating capital losses. So way to play offense in a bad environment, rebalance the portfolio. If you net losses at the end of the year, $3,000 is going to be used to reduce ordinary income, and then additional losses beyond that will be carried over to reduce future capital gains. So you can bank as many losses as you theoretically want. If you have a net loss at the end of the year due to rebalancing of minus $23,000, $3,000 will be used to lower income, $20,000 is going to be carried over and used to reduce capital gains in future years. So that's pretty important. And the most common and probably the most impactful way of reducing income is retirement account contributions. Shane, why don't you take it on an employer level and speak to what are some of these figures, what are the deferral amounts that we currently have in play for 2022? Again, I think the key takeaway is, hey, we're mid-November. Do an assessment of where you are year to date and see if you can do some catching up to maximize that benefit.
Yeah, it's well put, Rory. And one thing I'll just add to the last slide before I talk about qualified plans here and contributions is with those losses, for a lot of our clients, I talked about this on the prior slide with RSUs or LTIs, some of those lots that you may be sitting on since 2010, 11, 12, 13, where you have some significant gains. This is an opportune year to look at how much you have in losses and see if you're able to match those up with some gains from prior years and get off kind of some of that single stock risk, so to speak, that we often talk about.
Point.
Another kind of something to think about when it comes to the end of the year. And obviously, as Rory talked about, you're going to be able to carry those forward. So we'd be able to do it next year anyway. But here we have qualified plans and essentially what you're able to contribute to retirement plans for calendar year 2022. It's a little bit ironic we're doing this today because I believe it was last week or the week before we sent out the new 2023 contributions. You'll notice, like everything, they've been adjusted up a little bit. But like Rory just mentioned, this is an opportune time, and it's ideal that we do this here in early November. Because it doesn't kind of catch you off guard and leave you with only 2 weeks to figure out, hey, what can I do, better here for the rest of the year to try and optimize taxes or max out my retirement accounts. So for calendar year 2022, under the age of 50 for a 401k, 403b, 457 for government employees, the maximum amount that you can contribute to a pre-tax or a Roth 401k, both are going to have the same limit. It could be a combination of the two as well, is going to be $20,500. For anybody over 50 years old, they can do an extra $6,500 for a total of $27,000 for the year. Again, so very important to know, this is a great time to go in, look at your 401k, see where you're at year to date. Remember,
Absolutely.
These are just your personal contributions. This does not include what the employer is putting in. This is just your personal contributions. This is a great time to go in, look at, hey, where am I at? How is my cash flow? Can I up my 401k percentage by even 1%, 2%, see how the cash flow goes. And again, every dollar that you put in there is going to reward you in future years and come retirement. For the simple salary IRA deferral amount, you're looking at $14,000 for 2022. Same deal as a 401k, 403b, 457. There is an additional catch up for over 50 years old as well, which is $3,000 for a total of $17,000 into the simple IRA. Now, this is a big one for a lot of clients and for a lot of employees who have this ability. Again, not everybody does. I know we don't here at Ausperity, but again, it's not everybody has this ability, but many plans and many employees that we and clients that we work with have the option of going above and beyond the pre-tax limit in their 401k and contributing to an after-tax bucket, or say an after-tax bucket that then gets converted to a Roth. So why this number here is important is for 2022, the max that you can put into a 401k, 403b, you name it, is $61,000. Okay. Now that is limited to the employer contribution plus your own contribution, and then 61,000 is the max. So let's say for easy math sakes, your employer is putting in $10,500. you put in the $20,000, 500, that is 31,000 total that you've put into the 401k. That means if your company allows, there is another $30,000, if you're a great saver, that you are able to put into your 401k, right? That will go in after tax. And ideally with most companies now, you're able to convert that after tax money to a Roth, right?
The
so
mega
think about
backdoor
this.
Roth,
Mega
right,
backdoor
Shane?
Roth. You've heard
perfectly
us say it many times. We have a YouTube video on it. You can YouTube it. But again, it's the mega backdoor Roth. As Rory just said, think about doing a $30,000 Roth IRA contribution in a year. It is extremely powerful. Again, it's not allowed by every single company, but if you have that option, even if you can put an extra 5,000, 10,000 in there, it's extremely powerful tool. And just like everything, who knows how long it'll be around for.
Right.
So again, $61,000, same deal goes with the over 50 years old. For the catch-up contribution, you're going to be looking at $66,500 total there for the catch-up contribution. The maximum annual benefit in the defined benefit plan this year for 2022 is going to be $245,000. Many of you or certain clients might know how they kind of classify a highly compensated or maximum compensated employee considered. That's $305,000 for the year. Again, I jumped ahead a little bit, but the highly compensated employee is technically $135,000 for this year. And then a key employee or an officer with the company is going to be maxed out at $200,000. So again, a lot there. It's one thing that I know Rory and Geoff and I always talk to clients about, even though we might only be managing, a piece of your wealth here. We're always trying to help with 401ks and what you're contributing and where you're at. So if you have any questions at all or wondering kind of where you're at right now in terms of contributions, can you do any more? Does your employer offer the mega backdoor Roth? Feel free to reach out to any three of us and we're happy to help.
Absolutely. Well put. In addition, right, sometimes common misconception, you have your 401k plan or your retirement plan. You can also make contributions to retirement accounts, whether they're IRAs or Roth IRAs. Whether or not you can do that or not from a deductibility standpoint in an IRA is going to be based on income. Again, it's why the importance of today getting an estimate, getting a rough standing of where your current income is, what your projected income will be through the end of the year, because it's going to determine whether or not you can or can't take advantage of some of the individual retirement account benefits. Roth IRAs, which we speak to time and time again, very important. To walk in the front door, so to speak, and to make a Roth IRA contribution is either yes or no. You're under the phase out or under the threshold. As you could see, my cursor's pointing to that. If you're married filing jointly, your income's got to be under 109 to make a full $6,000 or with the catch-up $7,000 Roth IRA contribution. So it's just knowing that and being able to take advantage of those opportunities. Additionally, if you're a self-employed individual, there's the solo 401k, which is going to apply to the previous thresholds and contribution limits that Shane mentioned on the last slide, or you can utilize a SEP IRA. SEP IRA is quick, easy, and cheap to set up, but it's got some different requirements in terms of maxing contributions and what is eligible for contribution. Not listed here is you can do upwards of the lesser of 25% of compensation or $61,000. So that's listed here as well. So just be aware that you can do IRA and Roth IRA contributions on top of any retirement plan. Whether or not you can deduct, whether or not you can make the Roth contribution is going to be determined based on your income. So once again, getting an understanding of what your income is and then proceeding accordingly. So that's it for most of the federal things you can do and planning items, if you will. We're going to take a few minutes here and speak to some state income opportunities and just some specifics that you should be aware of, because as you're going to see, it varies a lot from state to state. Geoff, why don't you take us through this, as I know this is something you've recently dealt with for a client here. Talk us through some of these state specifics that our clients and those listening should keep in mind come tax time.
Thanks, Rory. The one thing I'll touch on before I dive into this, a lot of mention about earned income in order to make Roth or IRA contributions. If you have a working spouse and they're earning income and you're a stay-at-home spouse, that married couples can consider the one and the same. So if you have a spouse that has earned income, you don't have earned income, you can still make an IRA contribution.
Perfect. Well, I'm glad, that's why that's why we're doing this with the three of us here. I missed it, so you jumped on that, but that's a great point. And again, while we're all beneficial to have on these calls, so I did glance over that. Thanks for picking that up. That's critical, and that's an additional $6,000 or $7,000 right there.
So, as you can see here, we've got listed 11 states that do not tax retirement income in some form or fashion. We're currently located and broadcasting to you from the state of New Jersey, which you do not see on this list. We'll shortly focus on a few states that we've seen, retirees retire to or flee to, and I'll share some considerations there. When we're referring to retirement income versus just income in general, as I mentioned, 8 of these states do not tax any form of income, Florida being one of them. So of course they wouldn't tax retirement income. Now, retirement income is pension income from a corporate or local state municipality. You've got IRA distributions, 401k distributions if the money remains in the 401k, and Social Security. Like I shared earlier, a majority of states do not tax Social Security, but few do. And right now we'll focus on some of the states that are a little bit more tax friendly, and then just some considerations with some of the other states.
Perfect.
If you can continue to the next slide. So states that don't tax retirement income, the two that I'm going to focus on here are Pennsylvania and Florida. Two kind of different scenarios. With Pennsylvania, they do tax earned income. However, retirement income is a different story. In order to qualify for your retirement income to be tax-free, you need to be retired. You need to be a Pennsylvania state resident and over the age of 60. Florida, again, they do not tax any form of earned income or retirement income. So, I think just about every state has seen folks, retire to Florida, and it's not always because of the tax benefits. I think some just like the warmer weather, which I can't blame them there. An example I've got listed here below compares Pennsylvania with North Carolina, and the reason I use North Carolina, again, North Carolina in recent years has somewhat become the new, I'd say
Florida.
South destination for the new Florida, if you will, but not always is it a tax-friendly decision. So they have no retirement income exclusion, and I'll talk to you a minute about what I mean there. So some retirement income exclusion, some states will have a certain threshold where the first $10,000 is tax-free, and then anything beyond that is taxed at a flat rate. But North Carolina, they're going to tax 5.25% on all earned income or all retirement income, excluding Social Security. So in this example, you see the difference between whether you're a resident in Pennsylvania or North Carolina. Two identical situations, you're looking at about a $4,500 tax savings.
Beautiful. Excellent example. And there's tools to help with that, and we can do that as well if you're contemplating a move and want to see the impact to taxes.
Yeah. When I refer to states that do provide certain exemptions on retirement income, I focused here, again, if we went through state by state, we would be here all day, but I focus on a few states that are sort of in our surrounding neck of the woods. New York, for instance, they're gonna provide the first 20,000 based on certain criteria to be exempt. Now, if you are a New York resident and have a New York state pension, well, that pension will be tax-free. So all of the income from that pension will be tax-free. But in order for that to be the case, you need to reside in New York. So as soon as you move outside of New York, then it becomes taxable. Delaware, a lot of people focus on Delaware for being a very tax-friendly state. Well, not so much when it comes to retirement income. The first $2,000 is excluded for individuals that are under the age of 60. After that, you're looking at the first $12,500 to be excluded, and that doesn't include Social Security. All of the states that I've listed here all all provide Social Security to be tax-free at the state level. Georgia, a little bit higher of an exclusion amount, 65,000. And then New Jersey, I'll talk about here in a minute. A lot of people, focus on New Jersey as being very, or not very tax friendly, especially when it comes to income in general or retirement income. They've implemented some things over the past couple of years that's eased that up a little bit. And if you can go to the next slide. So this came to play, I believe it was 2017, and they slowly have phased in this exclusion amount. However, the first couple of years, there wasn't a whole lot of individuals that would qualify because the exclusion amount was fairly low. It sort of hit the precipice in 2020 for a married couple with income under $100,000. And when I say income, I mean New Jersey state income. So you can exclude Social Security from the equation. You can exclude tax-free income. It's New Jersey taxable income under $100,000. Then all of their retirement income would be tax-free. So think of an individual with, they're collecting Social Security, but that's out of the equation. Both are retired, no earned income from employment, and their IRA distributions keep them under $100,000. Well, all of those IRA distributions will be tax-free at the state level. Wow. They'll pay federal tax, and this is important because when you set up an IRA distribution, like Rory and Shane mentioned earlier, you're going to want to set up a tax withholding. But if you're withholding at the state level, you're distributing more money, hence increasing your taxable income, and it becomes a double-edged sword where that's something that analyzing or projecting where you're going to fall from an income standpoint becomes very important in this case. In order to qualify, you or your domestic partner, spouse, need to be 62 or older, so at least one of you. You need to reside in the state. And in 2021, they took that income threshold from 100,000 up to 150,000, but there's certain caveats to that. Prior to this increase, when you went 1 penny over 100,000, then all of your retirement income was taxed. So this is a little bit different than Delaware and Georgia and South Carolina, where they excluded the first 30,000 or the first 12,500 or the first 65,000. In New Jersey, once you go 1 penny over 100,000, then all of that retirement income would be taxed. Again, very important to kind of analyze. If you can jump to the next slide, I'll show you kind of where we've gone from there. So married couple filing joint under 100,000, then all of the retirement income is tax-free. If you're single, that income threshold 75,000. So in this case, you see in normal circumstances, or I'd say more often than not, it's like a 1-to-1 ratio, where a single individual would have a threshold of 50,000, married couple would have an income threshold of 100. In this case, it might behoove a couple to file single versus married filing joint. Now, below you can see where we've kind of where the adjustments that have been made since 2020, and individuals that go over 100,000, and I'm going to focus on the married filing joint. If you go over 100,000 but are below 125,000, then 50% of the retirement income will be taxed. The other 50% will not. And you see those other income thresholds below. Once you go over 125 but are below 150, that number is reduced to 25% will be excluded or tax-free, 75% will be taxed. Once you go 1 penny over 150,000, all of the income is taxed. And New Jersey's, state income tax, it's not a set percent. It's somewhat of a sliding scale based on how much income you make, but it can range anywhere from 6% all the way up to a little bit north of 10%.
Sure. Great. Well, a lot there. Really appreciate that. Very thorough. And with us being in New Jersey and having a large number of New Jersey residents, I think it's important to know where you stand and the impact of maybe having an income event pushing you over that one penny and theoretically making a good portion of your income taxable in the state of New Jersey. So hopefully you have a few takeaways from this discussion today on the state level, but then also on the federal level. And we have a little over a month and a half to make any potential changes to either increase income through Roth conversions if beneficial later down the road, or exercising options, things of that nature, or some things that you can take advantage of to reduce income or maximize benefits, like maxing your 401k plan. If you are planning on utilizing the mega backdoor Roth strategy, that's a big number, $61,000. Are you on pace for that? If you're not on pace for it, can you increase contributions and fully take advantage of that? So there's a number of things to think about from a planning perspective. I think it all starts with getting a rough estimate to what your current income is, what your projected income is going to be, and then where are the planning opportunities that you can take advantage of to benefit your situation and that of your families. Again, we're here to talk through this on an individual perspective, so feel free to reach out to us. Again, connect with us and follow us on our YouTube channel, and appreciate everyone that tuned in here live today. Shane, Geoff, thanks again for doing this, and all of us at Ausperity. We hope you have a great Thanksgiving with your families. Thanks for tuning in, and we'll be in contact soon. Thanks.
Thank you.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.